This is our Forex blog video for November 13th, 2013, and these are our currency indexes, which are, in my opinion, the easiest way of trading. You can see the dollar, the yen, the euro, the pound as a chart, and you can clearly see when nothing's going on. It's in a nice little tight range, and when it breaks down, you can see when it comes back up to the highs and can't get above it, it's very likely to trend down again and also go a lot farther, because traders that saw the false breakout before, those who bought the lows are not going to buy the next time because it didn't work. And you can see the dollar trended down, went sideways to down all day. And so you basically want to sell the dollar versus whatever currency is strongest. The pound went from underneath to above its hourly moving average and broke out right here around 5. At 5 o'clock, you can see the dollar was, basically going sideways. You could also trade the pound versus the euro, which is also underneath its hourly moving average. So we'll bring up a pound dollar chart. You're looking to buy this, especially once the dollar breaks down here and a little bit later during the US session. And that's exactly what happened. You can see, looking at this pound chart, breakout, a nice little flag pattern, wedge pattern, another breakout that goes up 25, 50, 75 pips. You buy the next pullback, it goes up. Multi-hour breakout right here, which unfortunately didn't really pan out, but you should have made a little bit on there. You got to be a little bit more cautious whenever the previous trade doesn't work. You have a nice little wedge pattern right here where volatility gets smaller and smaller. It breaks out. And the key to trading is small losses, big wins. When you take this trade right here, this is what your risk, and you have an idea of what the next profit target is. This is somewhere maybe a little bit less than that is how much you made, but you can see it's many multiples of what your risk is. That's the key to trading, and also you can use fib targets off the last wave to get an idea of where that profit zone is. And so you buy that breakout right here. This is your risk. This is your likely profit. It's possible it can go all the way up to the next fib target. But either way, your likely profit is 3.5 to 5 times more than what your risk is. And the currency index really allows you to focus on the strongest trending pairs. The pound is strong. We also saw that the euro was weak, so you want to sell the euro pound. Same exact thing. You have a breakdown right here, which is really a decent trade, a nice little flag pattern here. And this is your risk. You draw your fibs off of this wave right here, and it's going to show you more than likely, your fib targets are down here. It probably stopped at the 1.618. Let's draw that on there just to see. And let's see what the previous swing high is. That's probably what fib targets it used. So I was a little bit off in my estimations on fib targets. This was your first one, your second one. Rarely, once it gets past the 1.618, typically it reverses soon after. So, some point in this area, you're going to, get out of that trade. Tends to form U patterns at fib targets and beyond. Same exact thing probably happened on the next wave, where the market kind of reversed. And it's kind of late today. I wrote a new article, why stochastics, RSI, and MACD indicators don't work and what does work. And you can take a look at that on our site today. Let's take a look at some other currencies. Nothing really was nearly as strong as the pound. However, you can see the Swiss was also weak. Went sideways, had a false breakout, couldn't get above the previous day's high, broke down right here, found resistance, So the pound was strong, the Swiss was also weak. So you want to be looking for pound Swiss buys. And when you're in the strongest currency, when there's really no other currency that's strong, only the pound, you're going to have days like this where they, this explosive move, little flag pattern, another explosive move, you buy the pullback, decent profit on that trade, you buy the pullback, another decent profit. And typically, during the most active times of the day, 3 o'clock till about noon, that's the most volatile trading time. Usually after that, you wouldn't want to buy that next pullback because the volatility dries up. You might only make 10 or 15 pips. So why risk, 8 to 12 or 15 pips when you're not likely to make more than that? You buy this pullback right here. It went up a little bit. You don't want to trade during the low volatility times because your risk equals your likely reward. It doesn't make sense. It's not worth risking your hard-earned money. So that's it for today's blog. Again, I spent all day today writing a Forex article, and I want to spend more time, at least one day a week, creating new content with text and video, lots of pictures and examples on various trading topics, and that's what I did today. So I'm not showing today's Forex signals because I really haven't looked at them today, haven't spent any time tweaking them, enhancing them, and improving them, but hopefully, like I do every day, the currency indexes really, they pan out. It works. It's the easiest way of trading. It's the highest probability way of trading that I've found, and it also tends to find the biggest wins. So there's no reason not to use it.